welcome to the Record Keeping Lab. In this video, I am going to walk you through an in-depth analysis of what cost and cost classification is. If your business is a product-based business, or you're planning on starting a business that is product-based, or you are a student, then this video is going to provide an insight to what you need to know. This is not just one of those regular contents, so do not skip. Please watch this video and gain the benefit of knowing what cost and cost classification actually is, and how you can use the knowledge of this concept to understand the cost volume profit analysis and turn your business into a profit-making business. Please watch, like, subscribe, and share this video to get to others. Let's visit the Record Keeping Lab. In this presentation, we will discuss cost and cost classification. Cost as it relates to a product-based business. Cost is simply the total amount of money spent on processing a product or manufacturing a product for business purpose. We can also say it is a cost incurred in making a product available for a business that is not into processing or manufacturing. It includes the cost of purchasing raw materials, getting equipment, machines, factories, the building that you use, and also the cost of hiring labor, workers, to do all these, and every other operational expense, that goes into making this product available. Cost is classified into fixed cost and variable cost. Fixed cost is the cost that does not increase according to the number of units being produced within the period, or the cost that remain constant irrespective of the number of quantity being produced by the company or being made available. It will include costs like the cost of getting a factory or building, the cost incurred on permanent staff that you paid, their payment does not change irrespective of units being produced or being paid on a monthly basis, and every other cost that does not change according to units being produced, the cost of equipment, like machines, that does not change. Meanwhile, variable cost is the cost that changes according to the number of units being produced. We can also refer to it as incremental cost. That means it increases, that cost increases according to the number of units or quantity being produced. And it's this kind of cost will be like the cost of purchasing raw materials, the cost of raw materials, the cost of fuel being consumed, and every other cost that increases according to the number of units being produced. For a pure water manufacturing or processing company, the fixed cost will be like the cost of machines being used, the building, the space, the factory being used. Then for variable cost, it will mean the cost of getting raw materials like the sand and every other chemical or preservative being used for processing that water, the nylon bags, the packaging, and every other packaging items being used that increases according to the number of units being produced, and the consumption of fuel as well. These will form part of the variable cost. Note that in the cost volume profit analysis concept, or the break-even concept, we find out that the fixed cost is measured by the total amount. The fixed cost is measured by the total amount, not in units. That is because the fixed cost does not increase according to the number of units being produced. And so because of that, when you're presenting it in that analysis, you present the fixed cost per period within the period. If the analysis is for a 1-year period, then the fixed cost should be presented annually, like that. Meanwhile, variable cost is measured per unit, can be measured per unit, is presented per unit in the cost volume profit analysis. That is because variable cost is a cost that increases according to the number of units being produced. So the more of a unit being produced, the more you incur that cost called variable cost. Hence, it is being measured per unit or per quantity in the analysis. So before you even start producing in a product-based business, you need to really understand what your fixed cost is all about and the various elements that makes up your fixed costs. And having known this, you need to arrange your fixed cost in such a way that you should be able to determine your annual fixed cost before going into that business for the purpose of doing your cost volume profit analysis. Now, in this discussion, we will be using the Price water processing company as our case study. How did we arrive at the 8 million naira fixed cost that was used in the previous video? Well, first, step one, we're going to estimate the purchase cost of all the various assets. We're going to estimate it and their useful life. And so we're going to create a table that will be having a 4 columns. column 1, you have assets, 2, estimated purchase cost, the useful life, and the amount that will be written off on a yearly basis as cost, that is depreciation. So we have all the elements of fixed cost, as we have water pumps, storage tanks, packaging machines, generators, building. Then these are the various elements that comprises of the fixed cost for the business. Now, for water pump, it is estimated that the business is going to invest a total amount of 1.2 million naira or 1,200,000 into the total installation of water pumps. Now, having gotten this, we need to now determine or estimate the useful life. The useful life is estimated to be 5 years. So using the straight line method of depreciation, we're going to divide the total amount of purchase cost by the useful life, which gives us 240,000 naira to be written off on a yearly basis. This becomes the fixed cost per period for water pump. The next is the storage tanks. The storage tanks comprises of all the various tanks that must hold water each time water is being pumped. It is estimated to be 1 million naira, and the estimated useful life is 10 years. So 1 million divided by 10 gives us 100,000 naira depreciation to be written off for tanks. Next is the packaging machines. As you are producing, you need a packaging machine that will be fitting the water into measurements and well packaged. So the cost of this machine is estimated to be 2 million naira. Now, using the same straight line method of depreciation, estimated useful life is 5 years. So dividing this by 5, you have 400,000 as depreciation to be written off on a yearly basis. The same thing applies to generators, which must be purchased, in case when there is no power, when there is no electricity, then you have to use a generator. The total cost of generator estimated is 1.5 million, and applying the same straight line method, we have 300,000 as the annual depreciation. Then building. Now, building here, we refer to the cost of getting a space, including the purchase cost of land, the building itself, and every other cost that was incurred during the course of setting up the building itself. So we can also refer to it as the factory space or office space. Estimated cost here is 5 million naira, though this is actually really backward if we are to compare it with the current realities, the current economic realities in Nigeria, 5 million naira. But again, we can also say that this building here could also be a rented facility, not a place purchased and built by the business itself. So the estimated purchase cost is 5 million naira. Estimated useful life is 25 years. Applying the straight line method of depreciation, 200,000 will be written off annually as depreciation. 200,000 will be written off annually as depreciation. But in case the facility is not under lease or rented facility, if it is a rented facility, rather, if it's not built by the business, the depreciation here, it will no longer be depreciation, but rather it will be annual rent. So the annual rent is what you now calculate as the fixed cost, that is for building. So when you add all the total depreciation for fixed cost, it amounts to 1,240,000 naira. 1,240,000 naira to be written off as a fixed cost element for non-current assets. Take note, all these items are non-current assets, or what we can refer to as fixed assets. So it means that we also have an element of fixed cost that have not been added, because in that our analysis, we found out that the fixed cost amounted to 8 million naira. So as we proceed, we will know how we arrive at the sum of 8 million naira. Apart from non-current assets, another cost element that can form the fixed cost is the staff salary, or permanent salary for staff that earn on a monthly basis, whose payment does not increase according to the unit work. So whether or not they get to a particular unit in production or a particular set amount of work or expectation, they are paid a fixed amount of salary, will be the next element of our fixed cost. Recall that, like I said, that the total fixed cost was estimated to be 8 million naira. So the amount that will make the fixed cost to become 8 million naira will be 6,760,000 naira. By the time you add this amount to what we have as our non-current assets cost, annual depreciation of 1,240,000, what we arrive at will be 8 million naira. So this is how we arrive at the cost of 8 million naira as the cost that will not change within the period of 1 year according to units produced. No matter what was produced or what is produced, this cost will remain unchanged. It will just be the way it is. In the next table that you're going to see, we'll see how this is presented accordingly. We'll also state this as well. All right, so you can see the table. The table is having two columns: fixed cost elements and annual allocation. So all the fixed cost elements that are subjected to depreciation, which are non-current assets, you can see them lining up, starting from depreciation of water pumps to depreciation of building. Now, by the time you add that figure, which amounts to 1,240,000 to what we estimated for yearly salary for staff, which happens to be 6,760,000, we now have a total amount of 8 million naira for the business annual fixed cost. Now, let's talk about the variable cost estimation for Everspring waters, not price waters. Now, the variable cost estimation for Everspring waters will actually be based on estimation like we did for the fixed cost. Now, we have the elements, the element of cost. We have the material elements and other consumables or operational elements. We have sachets, which cost 10 naira per every unit. 10 naira per every unit produced. Now, the nylon for packaging a bag, that is a unit of 20 packets of pure water, is 5 naira per unit. Now, for activated carbon, is 8 naira per every unit of sachet of pure water bag. Now, for sand, we spend 4 naira for every bag. For microfilters, is 15 naira. Ultraviolet is 10 naira. Corrosive is 6 naira per every bag produced. Now, electricity bill is divided into 20 naira per every unit produced. That is, for every bag produced, 20 naira goes into electricity. For fuel, that is when we put on generator where there is no power, we spend 18 naira per every bag produced. And for labor, we spend 24 naira. Now, the cost of labor here is the daily wage paid for filling, sealing, and packaging. It means that for the labor workers, they are paid 24 naira per every unit or per every bag of pure water produced. By the time you multiply this 24 naira by the number of units they produce in a day, we get how much that they are paid. Now, by the time you add up all of this number from 10 naira to 24 naira, we'll have a total amount of 120 naira, which amounted to our variable cost per unit that was used for Everspring cost volume profit analysis. Now, how do we actually break down this cost into these smaller units for each of these cost elements? We do this by dividing the total amount of material, the total amount of material cost divided by the units produced. It will now give us the cost per each of these elements. But how do you allocate cost for other operational costs like fuel, for instance? How do you allocate the cost of fuel? We also use the same method, but we can do this using machine hours. We'll talk about this more in the next section of this video, and we'll also see how we can use all of these to project for future profits. Allocation of fuel cost. Allocate fuel cost using machine hours. Assuming machines work 8 hours per day and factory consumes 2 liters per hour, fuel costs 950 naira per liter. How do you allocate? To do this, find the total liters consumed daily, and that will be 2 liters per hour multiplied by 8 hours for the day. That gives you 16 liters. Next, find total fuel consumed in naira daily, and that will be 16 liters multiplied by 950 naira per liter, which gives us 15,200 naira. Therefore, total bags produced daily will be fuel costs in naira divided by fuel cost per unit. That is 15,200 naira divided by 18 naira. That amounts to the unit produced per day for 8 hours will be 844 units. And so if the company works 22 days per month, it will produce a total of 222,816 bags or units for a year.
So the company will be breaking even at 100 units and will also be profiting from the remaining 122,816 units multiplied by 200 naira in revenue per unit. That gives us 24,563,200 naira profit for the year.
Thanks for watching this video. And please, if you've not liked this video, please do so and subscribe to this channel if you have not done so. But how do you apply this cost classification method to your product-based business that is a bakery business or a poultry farming business? Let me know in the comment section. Or if you are having issues applying these methods that we have just discussed, you can equally reach out to me and let's do your cost classification and your cost volume profit analysis together. Note that for you to carry out these various steps, you need to do a proper research on your business niche. Studying the business, studying the trend in the business, carrying out practicals on a daily basis to study your cost within the period for you to come up with a very good plan for this. If you equally have any question or a review of this presentation, you can equally reach out to me or do so in the comment section. Thank you very much and bye.